Hello and welcome to this video where we will be discussing the investment philosophy of one of the most successful investors of our time, Warren Buffett. Warren Buffett is the CEO and chairman of Berkshire Hathaway, which is one of the largest publicly traded companies in the world. Over the years, Warren Buffett has become a household name due to his exceptional investment strategies and his unique approach to investing. In this video, we will be exploring the key elements of Warren Buffett's investment philosophy and how he has managed to achieve such great success. 1. Invest in what you know. Warren Buffett has always emphasized the importance of investing in what you know. This means that you should only invest in companies that you understand and that have a sustainable competitive advantage. Before investing in any company, you should conduct extensive research and analyze their financial statements to ensure that you fully understand their business. This approach helps to minimize the risk of investing in companies that are outside of your area of expertise. Buffett is known for investing in companies that he personally understands and has confidence in. For example, he invested in Coca-Cola because he loved drinking the company's products and believed in the strength of the brand. Similarly, he invested in Dairy Queen because he was a big fan of the ice cream chain. Buffett believes that the best investments are those that you can hold for the long term and that have a strong business model. Therefore, it's important to understand the company's competitive position in the market, their management team, and their financial statements. By doing so, you can identify companies that are undervalued and have strong growth potential. In addition to investing in companies you know, Buffett also suggests that investors focus on companies with a sustainable competitive advantage. This means that the company has a unique product or service that is difficult for competitors to replicate. By investing in companies with a competitive advantage, you are more likely to generate consistent returns over the long term. Overall, Warren Buffett's philosophy of investing in what you know and understand is a crucial part of his investment strategy. By sticking to this principle, you can minimize the risk of investing in companies that are outside of your area of expertise and increase your chances of generating long-term returns. 2. Focus on intrinsic value. One of the key principles of Warren Buffett's investment philosophy is to focus on the intrinsic value of a company rather than its market value. According to him, the intrinsic value of a company is the true value of the business, which takes into account its earnings, assets, liabilities, and other factors. By focusing on intrinsic value, Buffett is able to identify undervalued companies that have strong growth potential and a sustainable competitive advantage. To determine the intrinsic value of a company, Buffett looks at a variety of financial metrics, including earnings per share, cash flow, and return on equity. He also considers the company's management team and their track record of success. By looking at these factors, Buffett is able to identify companies that are undervalued by the market and have the potential to generate significant returns over the long term. It's important to note that Buffett's approach to intrinsic value is based on a long-term perspective. He does not focus on short-term market fluctuations, but rather on the long-term prospects of the company. This means that he is willing to hold on to investments for years, even if they do not immediately perform well in the short term. One of the ways that Buffett determines the intrinsic value of a company is by comparing its market value to its book value. The book value is the total value of a company's assets minus its liabilities. If the market value of a company is significantly lower than its book value, it may be an undervalued investment opportunity. Overall, Warren Buffett's focus on intrinsic value is a crucial part of his investment strategy. By looking beyond the market value of a company and focusing on its true value, he is able to identify undervalued companies with strong growth potential and a sustainable competitive advantage. 3. Margin of safety. Another important principle of Warren Buffett's investment philosophy is to always invest with a margin of safety. This means that you should only invest in companies that are undervalued and have a large margin of safety. This approach helps to minimize the risk of losing money and allows investors to generate long-term returns. To understand the concept of margin of safety, imagine that you are building a bridge. To ensure the safety of the bridge, you would not build it to exactly meet the required weight-bearing capacity, but rather build it with a margin of safety to handle unexpected events or future changes in usage. Similarly, in investing, a margin of safety allows you to handle unexpected market fluctuations or changes in the company's performance. Buffett believes that investing with a margin of safety is crucial to successful investing. When investing in a company, he looks for a wide gap between the company's intrinsic value and its market value. This means that he only invests in companies that are undervalued by the market and have a large margin of safety. By investing with a margin of safety, Buffett is able to minimize the risk of losing money and increase his chances of generating long-term returns. Buffett also suggests that investors should be patient when it comes to investing with a margin of safety. This means that you should not rush into investments, but rather wait for the right opportunities to present themselves. By being patient and waiting for undervalued companies with a large margin of safety, investors can generate significant long-term returns. Overall, Warren Buffett's approach to investing with a margin of safety is a key part of his investment philosophy. By investing only in undervalued companies with a large margin of safety, he is able to minimize the risk of losing money and increase his chances of generating long-term returns. 4. Long-term investing. Warren Buffett is a firm believer in the power of long-term investing. He has always emphasized the importance of investing in companies that have a strong business model and that can generate consistent earnings over the long term. According to him, the best investments are those that you can hold for the long term and that have a sustainable competitive advantage. Buffett's long-term approach to investing is based on the idea that the stock market can be volatile and unpredictable in the short term, but over the long term, it tends to reflect the underlying strength of the companies it represents. This means that by investing in companies with a strong business model and a sustainable competitive advantage, investors can generate consistent returns over the long term. To identify these types of companies, Buffett looks for companies that have a strong brand, a loyal customer base, and a sustainable competitive advantage. He also looks for companies that have a history of generating consistent earnings and that have a clear path to future growth. By investing in these types of companies, he is able to generate significant long-term returns. One of the key advantages of long-term investing is that it allows investors to take advantage of the power of compounding. Compounding is the process by which your investment returns generate additional returns over time. By reinvesting your earnings back into your investments, you can generate significant returns over the long term. Overall, Warren Buffett's approach to long-term investing is a crucial part of his investment philosophy. By investing in companies with a strong business model and a sustainable competitive advantage, he is able to generate consistent returns over the long term. By taking a patient and disciplined approach to investing, investors can also benefit from the power of compounding and generate significant long-term returns. 5. Patience is key. Lastly, Warren Buffett has always emphasized the importance of patience when it comes to investing. He believes that investors should not try to time the market or make short-term investments. Instead, he advises investors to focus on long-term investments and to be patient when it comes to generating returns. By being patient and holding onto your investments, you are more likely to generate consistent returns over the long term. One of the key reasons that Buffett advocates for patience in investing is that the stock market can be volatile and unpredictable in the short term. While short-term investments may generate quick returns, they are also more risky and less likely to generate consistent returns over time. By focusing on long-term investments and holding onto them, investors can ride out short-term market fluctuations and generate consistent returns over the long term. Another reason why patience is important is that it allows investors to take advantage of market opportunities that may arise over time. For example, if the market experiences a downturn, patient investors can take advantage of undervalued opportunities and buy stocks at a discount. By taking a long-term view and being patient, investors can benefit from market opportunities that others may miss. Buffett's approach to patience is also based on his belief in the power of compounding. By reinvesting your earnings back into your investments, you can generate significant returns over the long term. However, this process takes time and patience. Overall, Warren Buffett's emphasis on patience in investing is a crucial part of his investment philosophy. By focusing on long-term investments, holding onto them, and taking advantage of market opportunities, investors can generate consistent returns over time. By being patient and disciplined, investors can also benefit from the power of compounding and generate significant long-term returns. In conclusion, Warren Buffett's investment philosophy is based on a few key principles that have helped him become one of the most successful investors of our time. These principles include investing in what you know, focusing on intrinsic value, investing with a margin of safety, long-term investing, and patience. By following these principles, investors can generate consistent returns over the long term and achieve financial success. Thank you for watching this video, and I hope you found it informative.